Yeah, welcome back to your second deep dive with us. We're really glad you're tuning in again.
Absolutely.
Because today we're getting into something super important.
Right.
Your money, basically. Personal finance, how to invest smarter, and crucially, how to figure out these huge shifts happening, globally. In the economy, technology,
Ah,
it's a lot.
it really is. And this isn't just like month-to-month budgeting advice, though that matters. It's more about understanding the big forces, the trends that are going to shape your financial world for years, maybe decades.
Yeah, being proactive, not just reacting when stuff happens.
Exactly. Proactive.
Okay, so our source material for this comes from this really insightful financial expert. He was originally on a well-known Arabic podcast.
Mm-hmm.
But the great thing about solid financial advice, the fundamentals anyway, is that it works anywhere, right? It's pretty universal.
That's true. The principles hold up.
So our job today is to take those rich ideas, translate them, adapt them a bit, and pull out the most important bits of knowledge for you listening in English. The goal is helping you feel really informed about your own financial path and the bigger context.
Yeah, we've tried to boil down a lot of info, really focusing on stuff you can actually do something with, and also highlighting these, well, pretty critical future trends.
Okay, let's dive in then. We've got some honestly surprising facts and really practical advice here. This guy has 15 years inside the financial system, so he knows his stuff.
He certainly does.
Let's start with maybe a bit of a wake-up call. The state of personal finance right now.
Right. It's fascinating, actually. You look across different countries, different cultures, and you still see some common threads in how people handle money, or maybe don't handle it so well.
Yeah, like saving.
Exactly, like saving. So the expert pointed out, for instance, Saudi Arabia's savings rate is around 18% of income, which might sound okay.
Maybe. I don't know. What's the comparison?
Well, compare that to China, often closer to 30%. Even the U.S., which gets a lot of flack for consumerism, is around 8%. And Europe, maybe 5–6%.
Wow, okay, so 18% isn't actually that high globally. And why is it relatively low there? Did he say?
He pointed to spending habits. Specifically, in Saudi Arabia, something like 45% of income goes towards luxuries.
45%, that's nearly half.
It's a huge chunk.
Yeah.
Compare that to, say, estimates for the U.S., maybe closer to 32%, when almost half your income is discretionary spending on non-essentials. Well, it makes saving tough.
No kidding. That definitely puts a dent in things.
And what's interesting is, these specific numbers aside, it highlights a broader challenge. It sort of raises the question, why do so many of us find saving so difficult, even when we know we should?
Good question.
Part of the answer, according to our expert, might be this culture of dependency.
Okay, what does that mean?
It's this underlying assumption, maybe subconscious sometimes, that someone else will take care of you later. The government with pensions, or maybe your kids will support you.
Ah, right. Relying on the future or someone else in the future.
Exactly. And that assumption bumps right up against the reality of retirement funding.
Yeah, you mentioned pensions, like Social Security.
Right. Things like that are often calculated just on your basic salary. They usually don't include bonuses, housing allowances, commissions, things that can make up a big part of your actual income.
Oh, okay. I didn't realize that. So your pension income could be way lower than your working income.
Significantly lower. The expert mentioned that people hitting, say, 60, 64 could see their income drop by as much as 40%. Just like that.
40%. That's massive. You can't just maintain your lifestyle with that kind of cut.
You really can't. It forces people to burn through savings, if they have them, or sell assets. It leads to stress, not the secure retirement people imagine.
So, okay, for everyone listening, how does this affect your retirement dreams? What's the practical advice here?
The advice is stark but simple. Start saving 20% of your income, and start from day one, your very first paycheck.
20%. Consistently.
Consistently. That percentage, if you invest it wisely over a career, could potentially let you keep your lifestyle going for, say, 30 years after you stop working, maybe from 60 to 90.
That makes sense.
Yeah.
It's about taking responsibility yourself.
It's investing in yourself first, secure your own future, and you're not potentially burdening your kids down the line. It's about self-reliance, really.
Okay, that covers the individual side.
Yeah.
What about the big players? The banks? Our expert had some interesting takes here too, right?
Oh, yeah. Very interesting. Saudi banks, for example, are incredibly profitable.
Why is that?
A big reason is their low cost of capital. Get this. About 85% of their deposits are in current accounts that pay zero interest.
85%. Wow. How does that compare elsewhere?
Well, in the U.S., it's maybe closer to 20%.
Yeah.
Most deposits in the U.S. are in accounts where the bank actually pays the depositor some interest. So having this huge pool of essentially free money to lend out, it really benefits the bank's bottom line.
Yeah, no kidding. That model definitely seems tilted towards the bank.
It traditionally has been. But here's where things get really dynamic. Fintech. Financial technology.
Right, the disruptors.
Exactly. They're shaking things up massively. Banks used to try and do everything, right? Checking, savings, loans, investments.
Yeah, the one-stop shop.
But now, fintech companies are picking up specific services and often doing them better or cheaper, especially for individuals. Payments, small loans, easy investment platforms.
So the banks are losing ground on the individual customer front.
To some extent, yes. And you see traditional banks, especially after mergers, maybe focusing more on the big stuff. Corporate finance, huge project lending.
Okay, so they're specializing more.
It seems that way. So even if banks merge, which might look like less competition, it doesn't necessarily mean fewer options for you as an individual. Fintech is filling that space, driving innovation.
That's a really key distinction. Okay, let's switch gears a bit. Another big topic,
Yeah.
the dream home.
Ah, yes. The big house with the white picket fence, or the local equivalent.
Exactly. It's been pushed as the ultimate goal for generations. But our expert really questioned that.
He did, because people often end up spending like 65% of their income just on the house payment.
65%. That's insane.
It is. Plus, you've got maybe another 5% of the home's value each year just on maintenance and upkeep.
Ugh, the hidden costs.
And then there's the liquidity issue. Real estate isn't like stocks. You can't just sell it instantly if you need cash or want to move. It can take months, sometimes longer.
Right. It ties up a huge amount of your capital.
A massive amount. Capital that could be doing something else. Growing, generating income.
So what's the alternative view he offered? Just rent forever?
Not necessarily forever, but he suggested thinking differently. Maybe renting is smarter if your housing costs stay under, say, 30% of your income.
Okay.
Or if you do buy, maybe go for something more modest. Don't stretch yourself so thin. Plus, in some places, like Saudi Arabia, there are government support programs, like interest-free loans for part of the price, that can make a smaller home more feasible.
Right. Leveraging support if it's available.
And consider this trade-off he laid out. Imagine owning a $500,000 property, all the costs, the illiquidity we talked about. Now imagine having that same $500,000 invested in a diversified stock portfolio instead. Realistically, that could generate maybe $40,000 a year in income.
Which could easily cover rent in many places.
Exactly. It really makes you think about the opportunity cost, doesn't it? What you're giving up by having all that money tied up in one illiquid asset.
That's a powerful way to frame it. Okay, speaking of investments.
Yeah.
Let's talk about how to invest wisely. A lot of people get scared off, right? They hear stories about market crashes.
For sure. He mentioned the 2006 crash in the Saudi market as an example. Lots of people lost a lot of money. Why? Because they were heavily concentrated. All their money in that one market, maybe even just one or two stocks.
Putting all your eggs in one basket.
Precisely. The absolute key takeaway, the antidote to that, is diversification.
Spreading the risk.
Exactly. Building a portfolio that's balanced. You need a mix stocks, maybe some commodities, maybe some alternative assets. And importantly, spread across different global markets, not just your home country.
Reduces the impact if one market tanks.
Significantly, it aims for more stable, smoother returns over the long haul instead of trying to hit home runs, which often leads to strikeouts.
Okay, so for listeners thinking, I'm not an expert trader, I don't follow markets all day, what does diversification mean practically for you? How do you actually do it?
Great question. And this is where things like index funds or ETFs, exchange-traded funds, are just brilliant for regular investors.
Explain those quickly.
Sure. They're basically investment funds that you can buy easily, just like a stock. But instead of buying one company, they buy a whole basket of companies, often designed to track a specific market index.
Like the S&P 500.
Exactly like the S&P 500.
Yeah.
You buy one share of an S&P 500 ETF, and you essentially own tiny pieces of the 500 largest companies in the U.S. Instant diversification.
And those have done well historically.
Very well, especially recently. The S&P 500 has averaged something like 12–14% annual returns over the last decade. That's way above the long-term historical average, mind you, but it shows the power.
So it's an accessible way to get broad market exposure without being an expert.
Precisely. And the key here is patience. Long-term thinking.
Right. This isn't get rich quick.
Definitely not. The real power of stock market investing comes over decades, like 25, 30, 40 years. That long time frame lets you ride out the inevitable bumps, the volatility, and lets compounding do its magic.
But there's a step before you start investing long-term, right? Something crucial.
Absolutely critical. Before any long-term investing, you need an emergency fund.
The safety net.
The safety net. Enough cash set aside to cover 6 to 12 months of your essential living expenses. And this money needs to be safe and easily accessible. Very low-risk accounts, like a high-yield savings account, even if interest rates are, historically low right now. It's not about returns, it's about security.
Got it. Emergency fund first, then diversified, long-term investing. Okay, let's zoom out now. The future economy. Things feel different now, don't they? Unprecedented, maybe?
Unprecedented is a good word. We really are in uncharted territory, economically speaking. Think about it. We've had long stretches of basically zero interest rates in major economies.
Right. Money's been cheap to borrow.
Super cheap. At the same time, government debt levels globally are sky high. And central banks have been printing money like never before. Trillions created out of thin air, especially after the 2008 crisis and then again during COVID.
So loads new money flooding the system.
Yeah.
Where does it all go? Why aren't we seeing massive inflation in, like, groceries?
Well, we are seeing inflation, but maybe not primarily in the consumer price index, not yet anyway.
Yeah.
Where it's really showing up is in asset prices.
Stocks, real estate.
Exactly. Stocks have soared. Property values in many places have gone through the roof. It's classic supply and demand. Too much money chasing a limited pool of desirable assets. It bids the prices up.
Okay, so what happens next? If interest rates are already near zero and we've printed trillions, what tools are left?
That's the multi-trillion-dollar question, isn't it? Our expert raised a really provocative point here. He suggested that maybe the current system, the fiat money system,
Meaning money backed by government decree, not gold or anything physical.
right, that system might be hitting its functional limits. He actually predicted a period of pretty significant instability, maybe the next 2 to 4 years, as the world potentially figures out a new global financial system.
Wow, a whole new system. That's huge.
It's a massive idea, and it's not happening in a vacuum. Technology is driving enormous change alongside this.
Right. The expert identified 5 key technologies, didn't he? 5 pillars of future transformation.
He did. First up, energy storage.
Batteries, basically.
Better batteries, yes, but maybe other forms too. It's the absolute key to making renewable energy like solar and wind truly reliable and scalable 2047. Without good storage, renewables have limitations. Solve storage, and you potentially unlock a fully renewable grid.
Okay, pillar 1, energy storage. What's next?
Second, blockchain technology.
Crypto stuff. Bitcoin.
It's the technology behind Bitcoin, but its potential goes way beyond currency. Think of it as a super secure, transparent, decentralized way to record anything. Land titles, voting records.
Like Estonia using it for digital services.
Exactly like Estonia. It can create trust and transparency in systems that desperately need it. Tamper-proof records. Huge potential.
Okay, pillar 3.
Artificial intelligence, AI. But not just basic automation. We're talking about AI that can learn from data and essentially write its own programs, adapt, and solve problems in ways we didn't explicitly tell it to.
That sounds powerful and a bit scary.
It's incredibly powerful. Its ability to analyze massive data sets is transformative. The expert mentioned, like, a single modern airplane flight generates more data than the entire world produced before 2008. AI can make sense of that flood. It's speeding up drug discovery, optimizing complex systems. The applications are endless.
Wow. Okay, what's number 4?
Robotics. And again, this isn't just physical robots welding cars. It's also software robots, automation for knowledge work.
Like AI reviewing legal contracts or accounting bots.
Exactly. Tasks that used to require human judgment are being automated. And this, the expert warned, is likely to lead to structural unemployment.
Meaning jobs disappearing, not just temporarily, but permanently, because the skills are no longer needed.
Precisely. Entire categories of work might just vanish. This poses a massive societal challenge. If millions can't find work through no fault of their own, how do we support them? How do we maintain social cohesion?
That's where ideas like universal basic income come in, right? UBI.
Exactly. Our experts suggested UBI might become less of a political choice and more of a moral and practical necessity to prevent widespread instability. It forces us to rethink work, value, everything.
Heavy stuff. Okay, the 5th pillar.
Fifth and final, genomics. The ability to read, understand, and even edit our own genetic code.
CRISPR technology and things like that.
Things like that, yes. The potential upsides are incredible. Personalized medicine tailored to your DNA, potentially longer lifespans, maybe eradicating genetic diseases, dramatically cutting healthcare costs.
But the ethical questions are huge.
Immense. Designer babies, genetic discrimination, extending life dramatically.
Am I?
What does that mean for resources, retirement, society? We're only just beginning to grapple with these.
So 5 massive technological waves hitting alongside this economic uncertainty: energy storage, blockchain, AI, robotics, genomics. What does this all mean for you, the listener?
It means staying informed and being adaptable are not optional anymore. They're survival skills.
Yeah, financial literacy, tech literacy, they're becoming baseline requirements. These changes are fast, and they will change industries, jobs, daily life.
And part of adapting is resisting the negative forces, like runaway consumerism. It's so easy to get sucked in.
Especially with targeted marketing getting so sophisticated.
Incredibly sophisticated. It knows your psychological buttons to push.
So practical steps, how do you fight back?
The expert had a simple suggestion. Track your spending. Just for a couple of months, write down everything.
The behavioral therapy exercise.
Yes. It can be genuinely shocking to see where the money actually goes. Another tip. Reframe luxury purchases in terms of your time.
How do you mean?
Calculate how many hours you have to work to afford that expensive phone or handbag. If you earn, say, $2,500 a month after tax, that's roughly $15, $16 an hour. A $1,000 phone isn't just $1,000, it's maybe 60, 65 hours of your life.
Oof. That puts it in perspective. Is that purchase really worth a week and a half of your work time?
Exactly. It forces a different calculation. And longer term, we need better financial education starting way earlier in schools.
Absolutely. Give kids the critical thinking tools to navigate this complex world.
Because the information is out there. You can learn the basics online, YouTube, wherever. And for personalized advice, financial advisors exist, but you need that foundation of awareness first.
Okay, so wrapping up this deep dive. The message seems pretty clear. Understanding your own habits, saving diligently, investing smartly through diversification. And crucially, staying aware of these huge economic and tech shifts. That's all connected, and being proactive is key.
It really is. It's about building that awareness, constantly learning so you can navigate your financial future, not just drift through it.
So maybe the final thought, the question to leave everyone with.
Yeah, I think the question is, knowing all this, the changing economy, the tech revolutions, how are you going to adapt your financial plan? How will you position yourself not just to survive, but to actually thrive in this rapidly changing world?
A really powerful question to ponder. We hope this deep dive gave you some food for thought, maybe some aha moments, and definitely some practical things to consider.
Hope so too.
Feel free to share this with anyone you think might find it useful. Keep exploring, keep learning, and apply what makes sense for you. Thanks so much for joining us on this journey into the deep dive.